Ryan, the Global Sustainable Total Return Bond Strategy launched last year. Now, 2022 was a difficult year for investors. How did it pan out for you and the team?
2022 was a really successful year for us, and I would define that in three ways. The first one being performance. As you said, 2022 was a really challenging year for fixed income, maybe the most challenging year in generations. And we're really pleased with our relative performance versus our benchmark and our peer group over the course of the year. The second would be asset growth. Again, in a really challenging year, we're really pleased that we were able to raise assets pretty consistently over the course of the year, but probably more importantly, start to build long-term partnerships with investors, that share the same values and that are really focused on delivering performance, but also thinking about helping to solve some of these existential issues that we face on both the environmental and social sides. And the last one is team. We've been so excited to add new investors to our team that bring very creative skill sets, but that are really driven and team-orientated and align with us to help grow the business and to deliver on these objectives of both performance and impact for our clients.
And you mentioned asset raising there. What do you think's really drawn in those early investors?
I think it's a really unique strategy, and there's a few things that stand out to me. The first is that it's a dual mandate strategy in the sense that it's about delivering traditional performance, but also delivering impact. But it also has really clear objectives. And the first is delivering long-term returns for clients. But there's some nuance there. We're really focused on smoothing out the ride for our investors in what can be a very volatile asset class. We want to be able to participate when markets are rallying and doing well, but more importantly, be able to defend on the downside. And we found that over the long term, if you can do a good job of protecting on the downside, then you can deliver really strong risk-adjusted returns for clients over the economic cycle. The second point is we really need to deliver bond-like characteristics for our clients. As I mentioned, it's a volatile asset class. And what investors have found historically is that when equities have drawn down and they've looked at their asset allocation mix, that oftentimes their unconstrained strategic bond strategies are down double digits alongside equities. So we have to be really focused on delivering those bond-like characteristics so that we can be the counterweight and the counterbalance to equity risk or other risk in clients' portfolios. And the last is on sustainability. We're committed to underwriting all of our investments in our strategy using our ESG research process, and that's corporates, it's securitized, and sovereigns, so that our investors can feel that we are being good stewards of capital, and that the investments that we make are helping to solve these issues that we face on both the environmental and social sides.
And you also mentioned the team. Now, Brown Advisory obviously has a very established fixed income team that focuses on sustainability, but you've also added some new members. What do they bring to the process?
Well, the first thing to say is that Brown Advisory has a long history of sustainable investing, an approach that's really differentiated. It's been happening at the firm now for over 2 decades on the equity side, a decade or more on the fixed income side. And so we feel very confident that we have this differentiated process across all the asset classes that we look at, but also geographies. And that's where these new team members come in. We've hired Erica Miyazaki-Ross to be a global emerging market corporate analyst, looking at emerging market corporates in all the different geographies of the world. We've hired Yassine El Mori to be our global financials analyst, looking at banks in Europe, in the US, and further afield. And we've hired Anna Rudgard as an ESG analyst to focus on financials and food and beverage sectors, but also to think about ESG from a macro perspective and the implications to our investments. And it really fits in terms of how we think about investing. This is a very dynamic and unconstrained strategy that looks across different geographies and asset classes based on where we think the opportunities are, but also where we think we are in the economic cycle. And philosophically, that's really important to us. In our view, we have to position the portfolio according to where we think we are in the cycle and not be dogmatic about it. And every phase of the economic cycle demands a different level of overall portfolio risk, but also a different composition of risk. Now, for example, if you think about the recovery phase of the economic cycle, so you're coming out of recession and monetary policy and fiscal policy are really easy and spreads are at their widest, for us, that suggests you would run the highest levels of portfolio risk. And the composition of that risk would be heavily skewed towards spread products like corporate credit and EM. That's where our new analysts come into play. But conversely, as you start to get over the peak of the economic cycle into the slowdown phase, that requires the lowest levels of portfolio risk, and the composition will be completely different. So much lower levels of corporate risk and higher levels of, say, risk-free rates in most cycles. And so it's very much aligned with our investment process. And so to bring in analysts with different skill sets, it can be really accretive to how we think about investing and putting risk on in the portfolio.
And with that, what does the portfolio look like today, and why should investors consider the strategy?
Well, 2022, really challenging year, but really for the first time, there's been an immense amount of value creation in fixed income. We've lived in a world post the GFC of extraordinary monetary and fiscal policy, which drove yields to zero or negative in much of the world. Spreads were extremely tight. And now following 2022, with inflation running at 4-decade highs in much of the world and really aggressive tightening of monetary policy by central banks, risk-free yields in the US, Europe, other countries are much higher than they've historically been. All-in yields for corporate credit are extremely enticing compared to where they've been historically. The value creation is providing opportunities in those markets, emerging markets, where we can really start to allocate capital for clients. But 2023 won't be an easy year. We still think there's challenges with inflation, that central banks will still be tightening policy, and that we're still defensive. But I think what's really enticing to us is that it's still an opportunity in 2023 for active management. The idea of just sort of buying credit risk and buying duration and just riding it off to the sunset, that's not happening anymore. Central banks are shrinking their balance sheets, they're tightening policy. And so it sets up really well for active managers to be able to manage through the cycle and to provide really strong risk-adjusted returns, we believe, for clients.